Hello, everybody, and welcome to Money Matters. If you like to make money and enjoy learning about crypto and other investment topics, please subscribe to the channel. If you enjoy the content, then hit that like button as well. Let's get into it. As usual, disclaimer, I am not a financial advisor, nor do I give financial advice. Let's remember that this weekend is in observance of Memorial Day to all of our fellow Americans who made the ultimate sacrifice for you and I. And hopefully you're having a wonderful, enjoyable, long, extended weekend with your family. Take a look at the markets here. Okay. Boring, which is fine. We want to be stable here. Now, if you take a look, I inlaid a small chart here, but it's the Bitcoin chart over the last month. And you can see that we've stair-stepped down into a different range. So we were ranging between like the probably mid 30s up to 40, hoping to poke up above 40. But in the past 4 or 5 days, we've dropped into a different range that you can see, which is fine. As long as we just keep maintaining within the 30s, we're in good shape. Again, I think that there's been a lot of turmoil in the market over the last week and a half, 2 weeks. And we're really in a consolidation resting period after the traumatic events of the big fall. So I'm imagining that the beginning part of June, probably the next few weeks, we're going to see consolidation, some side-to-side movement. We'll see some. Yesterday we had some pretty good performers. ADA and Uniswap had double-digit gains. So I think we're going to see some breakouts from some different altcoins to their all-time highs or to where they need to go by the end of this bull run? No, I don't think so, not yet. But I think we might see some activity that starts to give some support. And once we have some positive information, positive activity, I think more people will become less trepidous and jump back into the market and see if they can't trade around and make some money. I don't know that we'll see the volumes that we've seen in the past with respect to speculative trading or leverage trading, especially on futures, until such time as Bitcoin starts to make a move up and is sustainable in that fashion. Because right now it's an unknown. So you don't see a lot of activity in that area. I'm not saying that there's not people buying, because there is, but looking in a positive note towards futures, I don't think we're going to see that for a while, or at least until Bitcoin starts to take off in price. So today I wanted to talk about liquidations. And this, of course, pertains to the past month where we had massive liquidations, 3 catastrophic events within the market. And I wanted to kind of go over what liquidation actually is, how it occurs, and how you can protect yourself from it and those that you love. So what is liquidation? Well, when you hear people say, I got wrecked in the market, and that's REKT, this is what they're referring to. And as they throw the term around like it's, oh, I got wrecked, but it can be devastating. We're talking about massive amounts of money and massive positions for people, regardless of the amount of money. It could be a huge percentage of their investment portfolio. So it's no trivial matter. But within the DeFi space, there's a lot of new types of financial instruments that are available to people. And it may or may not be that folks are sophisticated traders or that they have a lot of experience, but these tools are available to them nonetheless. So there's certain YouTube influencers that tend to really glorify, and I'm going to say that is because the way I see it, glorify leverage trading for whatever reason. Maybe it's advertising, sponsorship, I really don't know. And I'm not saying that you cannot make a lot of money leverage trading, because you can, but with great reward comes great risk. And with massive gains, there's a potential for massive, if not complete loss. And when I say complete loss, I mean your entire portfolio is vaporized. It is gone. You have to start all over from square one. So what I'd like to do is kind of go through an example of how this works so that you can better understand it. And this ties in closely with what we were talking about with respect to AAVE, because we're looking at platforms that lend money and platforms where people can borrow money And a lot of times these people are borrowing money to trade. So they're actually borrowing money with a different account, or they're using something like Bybit where they're doing the exact same thing. They're leverage trading. So they're basically collateralizing a loan or a trade for Bitcoin or something else in the future, and they're risking their portfolio. So even though Bybit is not a loaning type platform, the function is the same. You're going to have to collateralize your loan or the amount of money that you're leveraging with your portfolio. And that could be Bitcoin, XRP, whatever's in your account, to make sure that your margin's covered. Margin being the spread in the price, whether it goes up and down. So if you're thinking, oh, well, I think that the price of Bitcoin is going up to 60,000 by the end of June, you could leverage a huge amount of money. And if the price goes up, you're going to make a lot of money. But if the price falls below a certain percentage, and we call that, well, we'll get into that later, but when it falls below a certain percentage, then it's liquidated. So, and we'll talk about how that liquidation happens too, because remember, we're dealing with smart contracts here. We're not dealing with human beings. We're not dealing with emotions. We're dealing with programs. So it's very cold, calculated, and extremely fast. Okay, so when we looked at, a few weeks ago, when we look at all of those billions of dollars that were lost in liquidation, there's two kind of classifications of investors. There's retail investors like you and I, or there's institutional investors or really wealthy investors. They have a lot of money. And of course, with a lot of money, you can make a lot more money than we could as small investors. The problem comes in when you're a small investor and you want to take advantage of or make the most of your leverage trading. You want to leverage more of your portfolio because you don't have as much. So let's just say that your portfolio is worth $10,000 and you want to make a killing. Well, you're going to probably tend to leverage close to that $10,000 so that you can make your maximum amount of money. Well, an institution or a really rich person has a lot more money. So they can take a very small percentage of their overall portfolio. Let's say it's let's just say 1% for argument's sake. They can leverage that and still make a ton of money because that small percentage is still a lot of money. Now, the kicker comes in with liquidation, because when you fall below a certain percentage, and that's a ratio between what you have as collateral and what the price is, you run the risk of liquidation. Now, you can mitigate or stop liquidation by increasing the margin amount or increasing the funds that are available within your portfolio. So let's say you're getting down close to where, let's say you hit 0% or you hit 150% or 200% of whatever you've leveraged, and it's going to liquidate your account. If you want to, you can put additional funds or make additional funds available, and that liquidation point goes up because your percentage ratio just changed. You put more money in, so you're safer now. The price can drop further and further the more money that you put in. Well, that's great for rich people because they have tons of money that they can put in. So when we look at these liquidations, initially, these liquidations are usually retail investors because they do not have any more money to put in. They're already over leveraged with the majority of their account portfolios we talked about. So when they get to that critical point where they're going to be liquidated, they have nothing else to put in. So they will be liquidated. And typically they're liquidated far sooner than a retail or an institutional or very rich investor. I'm not saying that they can't be liquidated, but typically if they're liquidated, they're only liquidated partially because they have stops in place and protections in place to make sure that they don't lose money. I would venture to guess that none of them actually lose any money unless they're doing some crazy type of speculation. So Bybit, which is a website where you can sign up to do leverage trading, loves this because large investors don't invest in Bybit. It's people like you and I, and more likely than not, or more often than not, those people are not sophisticated or really educated or experienced investors. So the likelihood of them getting, quote, wrecked or losing all of the money in their account is extremely high, and they lose their money. They lose it all the time. So whales and institutional investors know this, so they really troll the waters looking for, and you can see how much money is being leveraged in the market, and they look for situations where they can short the market, where they can do some sort of market manipulation and just actually wreck all of these retail investors. It's pretty devastating, really. Okay, I'm prepared for this. I still haven't got my new clicker, but I'm prepared. There we go. Whoop, wrong way. There we go. Okay, so in this diagram, this should look pretty familiar because this is the same scenario where people borrow money from, we're going to use, you can say AAVE, or you can say BitBuy, you can say whatever you want. We'll just use the term synonymously. People are borrowing money. So liquidation, by definition, liquidation can happen in the real world too, in traditional finance. If you have something, so let's say you have a car loan, you don't pay your car loan, they'll come repossess your car. That's a type of liquidation. They're liquidating that asset, and they can actually take that car and sell it at a loss and then sue you for the difference. So if you owe $10,000 on a car, they repossess it, they sell it at auction for $5,000, you still owe them $5,000. They're coming after you for that $5,000. So the same thing holds true in traditional finance. If you don't pay your bills, or if you don't pay back your loan, they'll go after your collateral. And it's the same for DeFi, because if you don't have the ability to pay back your loan, they'll liquidate your account so that they can have the money to pay back their account. And they really have to do that to maintain liquidity within the application. So this smart contract and this system is designed to operate in a very efficient manner. And if it's not discriminatory, if you're at the point where you're going to be liquidated, you'll be liquidated. It doesn't matter who you are, where you live, nothing. It'll happen automatically with no emotion, no nothing. So basically, within this DeFi protocol or the smart contract, it's going to make the decision saying, hey, we have limitations on this particular trade. This person borrowed a certain amount of money. They can't pay it back now. It's going to be liquidated. Now, how is this liquidated if it's a smart contract? Well, what happens is that there are liquidation bots. And believe it or not, I went online and did some research, and it took me, maybe it took me about 35 minutes to create one. And you have to get a little server account for $5 a month, and then you have to have a node, Ethereum node, and you have to download the scripting and do some command line stuff. But it wasn't really very hard to set up. And you have to have a wallet so that you can pay ETH for the transaction fees, and you have to be able to back up the collateral that you're covering. But my point is that it's extremely easy to build these bots. Why is it so easy? Because all of these companies like Bybit create these bots and they put them out there as an open source so people will have them and use them. Why? Well, they want people to be liquidated as soon as they have to be liquidated so that they can get their money. And they're not doing the work. They don't do the work. That's not their job. They write the smart contracts. The smart contracts run themselves. They need this third-party bot system to go out there and automatically find these accounts that need to be liquidated and liquidate them. And if you run one of these bots, you're paid a percentage of whatever that liquidation amount is. If it's $100 or if it's $100,000 or $1 million, you get a percentage of whatever that is. So it can be very, very lucrative if you have the right bot running, and it's competitive. So there's more to it than that. But my point is it's very simple to create these bots. There's thousands of them running, and they liquidate constantly. So when you talk about a liquidator, as it is in this diagram, that is actually a program, or me running a program that would liquidate somebody's account. Sorry, I gotta make sure, scrolling down moves the slide. Let's look at an example here. And hopefully this makes sense as we walk through it. And where we have AAVE here, you can put Bybit. I think that AAVE is I would look at them more of a positive player within the market, whereas Bybit is more of a sinister element due to the fact that they really prey upon investors that are not very experienced, and they are very profitable. So I don't think I know everybody's responsible for their own money, but I've also seen a lot of the advertising that goes along around this, and it can be very compelling to get people on these platforms. But let's just say that I want to leverage trade, or I want to do a type of trade where I actually own Ethereum. I'm going to deposit that within, let's say, BitBuy or Bybit, and then they're going to give me an asset that I can use for whatever purpose I want. Well, the purpose I want today is I want to buy additional Ethereum. Why? Because I think Ethereum is going to go up in price. I only have 10 Ethereum, and I want to be able to buy more to take advantage of what I think is going to happen. The price is going to go up. So what I would do is I would deposit my 10 Ethereum into Bybit or wherever, and then I would get a stable coin back. So in this case, it's going to be DAI, and it's going to be a smaller dollar amount that it would be for than it would be from what I'm putting in, because you have to over collateralize. But let's just say for argument purposes, it's the same amount of money, because that's not the important part here. We want to see what happens when we go through this. So now I've put my 10 ETH into Bybit or wherever. I have my DAI out. So I can say, okay, well, I want to buy some more Ethereum. So I go to Uniswap, which is an open decentralized exchange. And I say, well, here's my DAI, give me 5 more ETH. So now, in all actuality, I have 15 ETH that are looking for this price to go up. If it goes up from, let's say it's $2,000, if it goes up to $3,000, I make that $1,000 on 15 ETH, not 10. Remember, I only own 10, but I've put up my 10 as collateral for an additional 5. So I'm betting that it's going to go up, and I'm risking my 10 that I own on that bet. So if the price goes up, it's good. If it goes down, well, that's not good at all. So let's talk about how we can look at this overall trade strategy and whether it's good or not for somebody who's in the market. So in that last scenario, when we were talking about taking something that you already own, that's already can appreciate or depreciate in value, but you have 10 ETH and you think you've been reading news articles and Mark Cuban's going to buy half the ETH that's available, so the price is going to go up, and you just got to have some additional ETH so you have a better position, and you want to borrow coins, or basically money, to buy some additional ETH. We went through that scenario. So you can actually do that. You can leverage whatever you have and get additional exposure to that market. The risk is that if the price goes down, you will be liquidated. There's nothing that you can do about it. It'll happen automatically, and it'll happen very fast. Unless, as we discussed earlier, you have some sort of additional funds to put into that Bybit account to cover the difference or the disparity in the price drop. So if the price drops, close to the level, and you have time, or if you put in some sort of a notification or whatever where you can add additional funds, then you can protect yourself. But it can happen extremely quick, and you would not have time to react, and you would be liquidated before you have that chance. So the risk is you could lose everything, but the benefit or the gain side of it is that you can really make a lot of money using somebody else's money. You don't have any more money, you can stake some of your money to get money to be able to do some additional stuff. So that's the premise of this type of trading, and the risk, of course, is liquidation. And hopefully you have a better understanding of liquidation. If you don't, then just think of liquidation as you putting up your hard-earned cash or your hard-earned cryptocurrency as collateral on a loan to buy more cryptocurrency, based on the fact that you think the price is going to go higher. If it goes higher, you've made a lot more money, but if it goes lower, you've lost all your money. So risk reward, you have to really take a look at it. In my personal opinion, and again, this is not financial advice, but in my personal opinion, leverage trading is absolutely insanity. Unless you're somebody who's really rich, really willing to drive down the highway and throw $20 bills or $100 bills out the window and not have to worry about it at all, I would not be leverage trading. It's not the strategy for anybody to really get ahead. There's much better, much more effective strategies that you can put in place that will garner you results as time goes by based on solid research and the understanding of different projects and the market. And not only that, it's pretty fun to do that too. If you want to gamble, just go to Vegas and gamble. That's fun, but you take $500. If you lose it, that's great. If not, who cares? You don't want to be leveraging your whole portfolio or giant parts of your portfolio to speculate on the price of cryptocurrency. Why? Well, last month we saw why. It can go down, and it could go down big, fast. And there was no indication that that was going to happen. It just happened, and people were, quote, wrecked. They lost all of their money. You don't want to be one of those people. So if you don't leverage trade. I don't, and I never will. Just for that reason. I'm not smart enough. I don't have enough information. I don't have the guts. I certainly don't want to risk my hard-earned money on speculative, that type of speculation. Let's put it that way. I guess any type of investment is speculation, but I'm not going to that risk level. If you hodl, if you just hold your coins, you never lose unless you sell it. So if you buy Bitcoin at 100,000 and it goes to $2, you still haven't lost anything until you sold it. So hopefully it goes back up over 100,000. Anyway, hope you like this video. You've learned a little bit about liquidation. I would love to hear in the comments below if any of you trade and what your experiences have been. Have you ever lost money? What's your experience been? I would be curious to know. And last but not least, winners never quit and quitters never win. Always give your very best effort to overcome the challenges that you face in life. I hope you have a great day. My day's been great so far, and I'm hoping it gets better. And I'll see you tomorrow.